I think a lot of investors right now are truly untethered to reality, and they're not paying attention to the signs that are out there that stock valuations are stretched, the economy is slowing down. And if those two trends continue, then I think it's a potential for very steep losses. In today's video, I want to talk about how I am becoming increasingly concerned about the state of the stock market and why that is. I'm calling it untethered to reality because, frankly, I think that that's exactly what is happening. So, just a quick disclaimer, none of this, I'm going to talk about some specific companies and the market in general, but none of this is investment advice. And you need to consult with your own tax, financial, and legal advisors regarding your individual situation. Okay, I'm going to start with the core issue, what I think are the main problems that I see, and then I'm going to dive a little bit deeper into the economic cracks, the problem of valuation, why timing is really important, because I'm not sitting here saying that this is going to happen immediately or today. The market was up today, it was up like almost 600 points. The Dow was, but why is timing important? Why could, if there is a bubble, or if the economy is going to continue to grow, what can influence that? And then where do we go from here? What should investors who are being prudent and hopefully attached to reality and not just following blind optimism, what should investors do as a result? Okay, so the problem right now is primarily a valuation problem. Over the last several years, increasingly, there's this fear of missing out, FOMO, and this narrative that AI is going to completely change the world. And that actually may be true. I'm not arguing against that. But what has happened is investors have bid up the prices of the stocks who are primarily in the AI space. A lot of those are some of the Magnificent Seven stocks. And so the not only are the prices high, that's not actually my concern. The price, it's not the price, it's the stretched valuations. And I'll talk about what I mean by that. The problem with this, when you have this arms race and all these companies are spending and investors are super excited about the prospect of AI and how that's going to revolutionize the world, if that comes to a collision with a economic downturn, or if the spend in AI, if the revenue doesn't catch up soon enough, this happened in the dot-com bubble. Like, everybody assumed the internet's going to change the world, and it 100% did. But a lot of the companies who failed in the dot-com, when the bubble burst, then they had overspent and the revenue didn't materialize and the capital dried up and the economy kind of took a little downturn. And a lot of these companies just completely poof, blew up and don't exist anymore. The problem here is one of optimism about growth, which is leading to stretched valuations. And this quote from this white paper, this is from Washington Crossing Advisors. If you go to their website, they have this piece. It's very short, it's 2 pages. The illusion of perpetual growth. And what they are talking about there is that 60% of the S&P 500 index value, so where it sits right now, and I this chart over here from JP Morgan shows where it sits right now, is priced as if superior growth can be sustained forever. Priced a meaningful slice, about 8 trillion in market value, is priced with an implied perpetuity growth assumption above 10%. Here's the central problem. No company can grow past the economy forever. The math will allow it. So, what this is saying is that the valuations of these companies, particularly the largest tech companies, are baked into their current stock price is the idea that the growth will be sustained at 10% annualized, above that, actually, in some cases, forever. No hiccups, no economic recession, nothing. Like, It's and what they're saying here is that this is so ridiculous because if you're compounding at 10% while the economy grows, even at optimistic US economic growth rate of 5%, eventually that company overtakes the economy itself, and that's not possible. These valuations and these growth rates are going to have to come back down to reality. And how that happens is anybody's guess, but it can happen in a very violent way, and that's what's concerning to me, especially at this time. This is another way to illustrate the problem of valuation right now. And this chart, I'm going to just focus on the chart on the right here, because this is the S&P 500. Down here is the PE ratio, the forward PE ratio. And then up here, it plots the annualized return for the next 10 years. So all these PE ratios is, you can see there's a huge cluster here. The lower this number is, the cheaper the market is. So the lower the valuation is, you're paying less dollars to buy a stock per dollar of earnings or profitability that the company makes. As it goes on here, you're paying more and more dollars to buy a share of the stock per dollar of earnings. So the stock becomes more expensive. You're paying a higher multiple, price multiple, for every dollar of earnings or profitability that the company has. So people are bidding up the prices of companies, and that's evident in not just the growth of the stock market and what we've seen, but the PE ratio that we're seeing as well. This chart is actually a little old. This was last updated at the end of 2024. So the PE ratio is actually higher. It's, yes, 22.8 as of 9/30. So it's right here further out along this 23x line right here. And what do you notice? Over the next 10 years, going back all the way to 1988, the range of returns pretty much all negative. So, a couple times maybe you hit zero, but when the PE ratio is 23, it's basically saying, look, over the next 10 years, not a single time in history going back to 1988 did you have a stock market that didn't basically produce zero returns per year on average over the next decade. And that is a dangerous place to be if you're close to retirement, if you're already retired, if you have a higher concentration in the Magnificent Seven or in the tech stocks where the PE ratios are the most stretched. The PE ratio of the Mag 7 stocks right now is 30. So it's not even on this chart. And that's what we see. The PE ratios get stretched, and then the returns, and it's a pretty, there's no outliers here. It's a clean line of distributions where it doesn't vary that much. And so it's a pretty reliable predictor of what could happen over the next 10 years, and not just what could happen, but what is actually likely given recent history going back about for the last 40 or so years. The stock market can keep growing, and it can keep expanding in terms of valuation, even to bubble stages, as long as the economy keeps chugging along. But I want to talk about how understanding the business cycle, where it's headed, that's really hard because you can't predict the future. You can't predict what's going to happen. But that is a key driver for where the stock market is headed. And generally, what happens is you have growth that slows down, these dominoes begin to fall, you have profits decline, you have unemployment rate spike, and then stocks drop. Generally, about in that order, the stocks start to drop once profits decline, and companies don't generally start laying off people in mass until they've had a pretty big hit to their profits. So this is the Conference Board's leading economic index. And what I'm showing here with this red line, it shows it peaked at the beginning of 2022. So this provides a indication of where the economy is headed in the near term. And you can see it's pretty decidedly moved down for 3 years now. The coincident economic index is still growing. And what you see is that, like, for example, back in '08, the leading economic index peaked, it looks like at the end of '05. And then it wasn't until the beginning of '08, so about 2 years later, when the coincident index peaked. And you can see these shaded gray bars here. These are recessions. So as long as this keeps growing, we can avoid a recession. But you can see it always lags. this coincident index, it lags and it can lag by a couple of years. And so it's still growing, but we can see the momentum in the economy is decidedly slowing down, and not just recently. Like, this has been going on for the last 3 years now. This more recently, according to the chief economist at Moody's Analytics, Mark Zandi, he says, are we in a recession? Well, yes, if you live in one of these 22 states. It is kind of divided. You have states that are, their economies locally are still expanding, and you have others, like where I live in Oregon, that are decidedly in a recession, at least according to Moody's Analytics. But you say, isn't GDP growing at 3.8%? Yes, that is the most recent GDP figures that came in. But what's interesting is that, according to Harvard economist Jason Furman, he says that's almost entirely driven by AI investment in data centers, information processing technology. These companies who have massive amounts of free cash flow profitability, they got lots of money to invest and build out the future of AI to win the AI arms race, which is what they're all trying to do. If you remove the massive spending related to AI and the development of that, economic growth, GDP growth, would have been 0.1% on an annualized basis. Pretty anemic growth. If you look at some of the dominoes that are falling, this is a tweet from Lizanne Saunders. I believe she's the chief market strategist at Charles Schwab, and she tweeted this out in April. So this is old at this point. I wish she would update it. I haven't seen an update from her yet. So I did my own update. Volatility rises in October. So stock market volatility. Actually, I take this back. I move this to the yellow, because what you see is that we have seen an uptick in volatility this year, but because the anticipation and because the Fed has started lowering interest rates, a lot of that has calmed down over the summer months and into the fall. And you only have little spikes in volatility, but not a broad rise in volatility. So I changed this answer. This is not red. Economic uncertainty is higher. Consumer confidence falls. I'll talk about this. Manufacturing drops. There's a ISM manufacturing index. If that figure is below 50, that signals that manufacturing is slowing down. It has been that way for quite a while now, not just like a couple of months, but going back quite a long time, like at least a couple of years. Manufacturing has been pretty anemic and showing signs of contracting. The labor market weakens. I'll talk about that. Unemployment is already up 1% from its lowest point, which is pretty decent size increase in the unemployment rate. ISM services activity below 50, that shows that. So you have the manufacturing side of the economy, you have the services side of the economy. Both of those are contracting. If they're below 50, that means the economic activity is, in services in particular, is contracting. Still in the yellow, inflation reheats, housing market deteriorates. I actually would maybe place this in the red, because you're starting to see certain markets that are decidedly in a correction, where prices have come down 10-20% from the highs in 2022. But there's just a lot of funky things happening with housing. GDP contracts. Well, that hasn't happened yet. It happened a bit earlier this year. A lot of the export-import activity related to tariffs is having an outsized impact on the GDP figures. It hasn't rolled over yet, but as I mentioned on the previous slide, a lot of the economic growth has to do with the AI and related investment, and not much else. Still haven't rolled over yet. Still in the green. Stocks, PE ratios, earnings per share growth, none of that has fallen yet. Credit hasn't tightened, although we have interest rates that have gone up, but you're seeing a lot of spending. You're seeing investors aren't demanding higher yields for higher risk bonds to the extent that you would expect. So credit is still pretty loose. People are not behaving as if the economy, or there's like a financial crisis. So that's still pretty loose. And then a recession hasn't been declared yet. But again, those are like 8 months delayed. So the recession starts, and then I think it's the National Bureau of Economic Research and BER. It takes them like 8 months to say, yeah, a recession is here. But it started 8 months ago. So we all knew it. So a lot of dominoes have already fallen, and the stock market is one of the last dominoes that really hasn't fallen yet. And the profitability of companies, because a lot of these businesses went into this current kind of slow deteriorating growth climate with massive margins, like the biggest margins, so they had a lot more cushion kind of heading into the current slowdown that we're seeing. So one bad omen for the economy is consumer confidence, because if you're pessimistic about, like, this headline, high inflation and lack of jobs leave Americans frustrated with the economy. If you are not confident, if you're pessimistic about the future, whether you're going to have a job in a month or 6 months, then you're going to tighten your purse strings and you're not going to spend as much. And so it's a leading indicator that the economy is slowing down if consumers aren't confident in the future. Like, they think things are getting worse, not better. And what we're seeing pretty decidedly since 2020, you can see this has trended lower. But the most recent reading in September of 2025 was a consumer confidence. This is the University of Michigan Consumer Sentiment Survey, 55.1. And you can see I drew a red line here, historically low. It wasn't even this low in the dip. You can see it's dipped lower. It wasn't even this bad in '08, which is insane, because you had, 10% unemployment. People were losing their house. I mean, it was I remember it. I'm sure you do too. It was an absolute bloodbath. The only time it was about as bad is here in 1980 during the recession here. That was super high inflation, and then the economy declined and people were absolutely miserable because inflation was high and the economy had deteriorated into a recession. So what you have is this huge uptick in consumer debt. So this is consumer loans, primarily credit card debt. And you can see since it bottomed out after COVID, this is COVID, it went down because we all got those payments to sit at home and not go anywhere. And then inflation kicks up here in 2021, 2022, and that's where you see the credit card explode. So credit card debt went from like 700 million here, maybe like 750 million here at the bottom, and now it's well over $1 trillion. So absolute explosion in credit card debt. So Americans are saddled with debt, and it's getting worse. Not only that, but you have credit card delinquencies. So people are, even though unemployment is still very low, Americans are sort of at their max. Literally, they're maxed out on their credit card, and then they're not paying. And what's also troubling is that if you look at the bottom here, the blue line is US, the green line with the highest delinquencies are people in the lowest income zip codes. But look what's happening down here. Even delinquencies are picking up for people in the highest income zip codes as well. So Americans across the board, regardless of income, are financially stressed. And so what this is an unsustainable path for spending. And when you have a consumer, the American consumer makes up 2/3 of the GDP output, the economic growth. If they're not able to continue sustaining their spending, it's going to have a correction here, and it's not going to be able to keep pace, especially when you look at the cumulative impact of inflation. Everything is very expensive, and most Americans are not on anything even remotely close to solid financial footing. My question on this slide, can the economy keep growing when Americans are this stressed? So we looked at credit card delinquencies. This looks at other various types of debt, student loans, mortgage debt, auto loans. So you can see auto loans have picked up. Here's credit card debt delinquencies. Now, these are 90 days delinquent. These are people who are like, they haven't been paying in 3 months. And you can see what happened with student loans. It went down sharply post COVID. It was pretty high before. I didn't realize it was this high, but it was over 10% of student loans that were more than 90 days delinquent. And that's been the case going all the way back to, it looks like 2012, 2013, post financial crisis. So, and then when those payments had to start again, you can see it just spiked back up. It looks like people, like 10%, everybody who wasn't paying before, they're just like, I'm still not going to pay. Now, thankfully, mortgage delinquencies, you can see that post COVID, it kind of bottomed out here, and it's slowly moving up. It's gone up some, auto loans, et cetera, but a lot of uptick in the financial stress among Americans. The unemployment situation is not bad yet. By historical levels, and this is what you see on the media, like all they report is unemployment's only, 4.3%. It sounds great because that's lower than it has been for going back many, many decades on average. But the problem is that it has gone up by about a percent since it bottomed out in April of 2023. So a 1% rise in the unemployment rate is a lot of jobs and a lot of people who are losing their jobs. And what happens, you can see here with these gray bars with the recessions, is it'll bottom out generally, and then you'll see these big spikes where there's massive layoffs, and you can see it coincides perfectly here with recession. So this is really the defining characteristic of a recession. You have to have a large and sustained increase in the unemployment rate, and we haven't seen it yet, but it is moving decidedly in the wrong direction. Also, the recent job growth, it's now negative. So ADP report that came out September, there was a net losses of jobs, but not just that. In 3 of the last 4 months through September, US businesses have actually cut jobs and job growth is now decidedly negative. That's what tends to happen. Companies, the last domino to fall inside of a company, they'll stop hiring new people. If people leave, they won't replace their jobs. They're not going to hire new people. They're going to keep what they have with the workforce and the size and the headcount that they have until they can't anymore, until their profits start to decline. And that has not happened yet. Companies, like especially publicly traded companies where we have this data, they had such large margins heading into this kind of malaise that we're in. They have not seen their profitability shrink to the point where they have to start massively laying off people. So we're not there yet, but it's moving in that direction. Okay, on a lighter note, someone who's decidedly not worried about any sort of economic downturn. This is my 2-year-old playing at the beach, loading up his dump truck with sand. And I just thought this picture was funny because it's such a contrast to, you know, I'm concerned about the economy and the stock market. He has no clue. He doesn't care. He's having a blast with his dump truck and his sand. I talked about this earlier, the valuation problem. Stock valuations, they're more than one standard deviation outside of historical norms. So you have this bell curve, if you remember statistics, and the stock valuations, the PE ratio, price to earnings ratio, generally falls on this spectrum or this bell curve. And we're outside of that. So the valuations are so stretched, it's actually well outside of what is the range of what is typical, normal, well beyond the average. And so when you couple that with the fact that the economy appears to be sort of teetering, possibly moving into a recession, certainly the growth momentum is slowing down. When you couple that, a economic decline and a recession, if there ends up being a recession, if you couple that with high valuations, it generally leads to pretty steep losses. And that's where my concern is, primarily with the concentrations in the very tech heavy stock market. Okay, so I talked about this before at the beginning, the untethered to economic reality. I just want to remember this PE ratio here of 22.8 and how stretched that is. This chart illustrates a couple of things. These are the companies that I wish I could spend a bit more time on this because I absolutely love this chart, but these are the companies in 1985, the top 10 companies in the S&P 500 and their market cap and the percentage of the total S&P 500. So pretty consistently from 1985 through 2015, the market cap was growing of these companies. It was 251 billion in 1985 and it was like 10 times that in 2005. But as a group, these companies kind of always hovered around 20% of the overall stock market until 2025. So since 2015, there's been this explosion, and the companies here in purple, they're all new. So it shows you, I like the visual here because the green, these are the top 10 in 85. And then it shows you which ones are still there in 95, which ones of the green are still there in 2005. And you can see there's turnover. So the dominant players in one era are rarely the dominant players in the next era. You have one or two that stick around for more than 10 or 20 years, but the turnover basically from over the last 40 years has been a complete turnover. And then you have companies, if you look at the details here, like Kodak. Filed for bankruptcy. You have companies that merged, they don't exist anymore. AIG, does anybody remember what happened to them in '08? A lot of financials here that aren't in the top 10 anymore. So the prevailing sentiment right now among investors in general is that the winners of the current era are going to continue to dominate indefinitely. That's why they're getting these 10% growth rates attached to their valuation, because the idea is that these companies are going to continue to develop superior results and returns for investors into perpetuity. And that's just not possible. And we've seen from history, history doesn't repeat, but it does rhyme. Does anybody think that if you fast forward 40 years, that it's likely that you're going to, or even 10, 15, 20 years, that's likely you're going to see the same subset of companies completely dominating the top 10? I think the answer is no. The other concerning thing is that the share of the total S&P 500 from just the top 10 companies is no longer around 20%. It's closer to 40%. So if you have a diversified S&P 500 index, 40% of your money is in 10 companies. 8% alone, I think, is Nvidia. And Microsoft, the size, the how thick these are shows their market cap and their weight in the index. Really concerning, because as I said here, big tech is basically the stock market today. So when you couple that with the fact that a lot of these companies are carrying eye-popping valuations and growth assumptions baked into their current stock price, it is a recipe for disaster potentially. I'm not going to talk too much about this because one of the issues that happened during the dot-com era is that they weren't wrong about the internet. The internet did change the world, but a lot of the companies that were completely obliterated in the dot-com bubble burst were companies that they were ahead of their time. Like, they were spending and investing and trying to build out all the infrastructure for the internet, but the revenue didn't materialize. And then the economy slowed down a little bit, and then the capital kind of dried up. And a lot of these companies just went poof. And that's why you saw the NASDAQ lose like 78% of its value from top to bottom, because a lot of these companies just were gone. And then you had companies who survived. Amazon survived, Microsoft survived. They came out of the rubble and emerged and have been tremendous growth stories since then. But the problem is when you have circular deals, like the companies in the AI space are doing a lot of deals with other companies in that space. The revenue from the outside hasn't really materialized yet. And the perfect illustration of this is that recently in September, there was a deal announced between Oracle and OpenAI. Their stock jumped. Oracle's stock jumped 25%. This is from Michael Sembalist, writing for JP Morgan, Eye on the Market. He said Oracle's stock jumped 25% after being promised $60 billion a year from OpenAI, an amount of money OpenAI doesn't even earn yet, to provide cloud computing facilities that Oracle hasn't built yet, and which will require 4.5 gigawatts of power, the equivalent of 2.25 Hoover dams or 4 nuclear plants, as well as increased borrowing by Oracle, whose debt to equity ratio is already 500%. So what they're saying is the tech capital cycle may be about to change. What he's saying is, like, Oracle came in up to the ante, and they're either going to have to issue a lot more debt, which they're already saddled with debt, or they're going to have to issue a lot more stock in order to pay for this. Like, where are they going to get the money for this? Because their business is not generating the revenue to be able to fulfill on this promise. And there's a lot of this happening with the other AI companies. And then you have the report that came out in August from MIT saying that the companies in the business world who are trying to apply generative AI pilots at their companies, they're failing. They're not producing any results, any measurable results in terms of increased productivity, higher profit margins, et cetera. Now, this is not to say that it's not going to happen. A lot of these companies are still experimenting with this, trying to figure out, like walking around in the dark, trying to figure out how to implement AI in their businesses. But the hard part is when you have all this massive amount of spending, and it is insane what these companies, these AI companies are spending and on track to continue spending as more and more of these deals happen. If the revenue doesn't materialize, like you need massive wide adoption from businesses. You can't just fund that with like, $20 subscriptions to the premium chat GPT version. That's not going to do it. You need businesses to adopt this at scale. And if that doesn't happen on the timetable, or if the economy slows down, people step back and say, you know what? Nope, I'm going to wait for things to improve. I'm not going to commit a bunch of capital to this. I'm not going to give you money for this, which is what Oracle's going to have to do. They're going to have to raise a ton of money to pay for this. Where are they going to get that from? If sentiment changes, it changes very quickly for tech. So in 2022, when the Fed was raising interest rates, the Magnificent Seven stocks as a group were down 41%. Now, a lot of people they don't remember this because it was down and then it shot back up again and it recovered very quickly. But then we saw this earlier this year in 2025, where this is a chart that shows the Magnificent Seven stocks as a group and their performance and how they did. And around Christmas to the bottom here with the tariffs in April, the Magnificent Seven groups lost about 30%. So those swings are wild. It's, of course, recovered like 60% since then. But when you have sentiment that can change, it happens very, very quickly, especially when the valuations are stretched. So any small disappointment, any hiccup results in a big downdraft in the stock prices. And we've seen that already. Even Vanguard here is sounding the alarm bell on US growth. Over the next 10 years, their capital markets model predicts that US growth on the low end will return 1.9% and on the high end 3.9% annualized rate over the next 10 years. What's most remarkable about this is that of all of the different categories of equity and fixed income returns, it's the worst. They're saying, I'm going to make more money sitting in US cash or US municipal cash compared to investing in US growth. That's that's pre- that's pretty bold. Look at US value. This is like the ugly younger sister who just nobody pays attention to. US value has not it's grown, but nothing like US growth, especially big tech. And they're projecting much more robust returns over the next 10 years on average for US value, which I also find interesting. And that's actually the best of the group here when you look at the range of returns. Fascinating. Okay, but of course, timing is everything because it's not guaranteed that we're going to go into a recession. I talked about how the higher profit margins allow more cushion. And so that's why we haven't seen a deterioration yet. If the economy is slowing down, businesses are still kind of limping along and still doing okay because they had such high profit margins heading into this current environment that we're in. It also explains why you haven't seen a lot of mass layoffs. Another important aspect of timing is that there's this old adage, don't fight the Fed. So the Fed has started cutting rates. They're expected to continue to cut rates, and that can add fuel for further market growth. Also, stocks are near all-time highs. Hey, their most recent high as of October 8th. Okay, so where do we go from here? We want to be very careful because you can also lose a lot of money by anticipating a correction or a market crash that never materializes. So you have to keep the long term view in mind. You have to make sure that you're preparing for a recession and dealing with a potential bear market without just saying, oh, throwing your hands up. The sky is falling. The sky is falling. We can't be chicken little about this. So there are a few action steps that I would recommend. So, one is reviewing your allocations. How much of your portfolio is currently in tech stocks? That is the most vulnerable area of the market. The high growth oriented, especially the tech stocks, those are where most of the assets and most of the money and capital is flowing into. And it's where people, I think, have mostly got out over their skis as expressed by the market valuations. Okay. How much of your portfolio overall is in stocks? Are you comfortable with the potential losses with that allocation? This is another interesting chart. Love JP Morgan. They do such a good job with these. Okay, average time to recover from equity market downturns. If the stocks drop by 10%, you can see it's about 10 months for if you have a 100% stock portfolio. It's about the same time frame if you have 60/40. But the time to recover, the spread gets bigger and bigger the more aggressive you are and the more in stocks you have. So if there's a 10% drop in the stock market, it takes about 2 years on average from 1988 to 2024 to recover if you were all in stocks. If you were 60% in stocks, it took about 11 months. The more the downturn, if it's like 30% or 40%, the longer the split is in the time to recovery. This is a portfolio stress test. I do this for our clients and we'll be sending these to all clients, but this can be done. You can kind of figure out how did your portfolio, you want to stress test your portfolio. And there are different ways to do this, but how would your portfolio performed over these are all the last 5 major market meltdowns. This green bar is the S&P 500. This blue bar is a more conservative 40% stock, 60% bond portfolio. You can see the drop was about half as much, and depending on the downturn, in the worst of the worst here, it was about half, and it varies across different ones. But it's important because then you can ask yourself, am I at a stage in life where I can accept a 41% drop in my portfolio value that's going to take years to recover? I think most people would say no. Again, this is the S&P 500. So the more aggressive you are, the more you're going to see this drop. Step number 2, if you find that you're like, I'm a little bit uncomfortable, and maybe I have too much in certain stocks, I have too much in stocks overall that I'm comfortable with, you want to take steps to reduce that risk. Can you reduce riskier individual positions or stock holdings? Even reducing your overall stock percentage by, like, if you don't have a high concentration in tech stocks, but you're like, I'm still concerned about the market and the economy, and I don't want to experience the pain of a deep bear market. Even a 10% reduction in stocks provides meaningful downside protection compared to where you're at right now, generally for most people. Also, you want to review your top holdings. These are the top 10 holdings in the S&P 500 right now. Where are your top holdings? How much of your portfolio is in, the top 10 stocks? Is it 10%, 15, 20, 30%? And which companies are those? If this is what your portfolio looks like, again, this is, I think, a very, you're playing with fire. Lastly, build up cash. Having cash savings, money in your bank account, money market, short term bonds, CDs, that provides a safety net in an economic and a stock market downturn. 6 to 12 months safety net of enough cash to cover your expenses for that time is a ideal place to be. If you're retired, I would also set aside an additional 12 months worth of your portfolio withdrawals. So if you take out 5,000 a month from your investments and you're retired, you want to set aside about $60,000. Is my math right? Yeah, $60,000 of savings on top of that, so you don't have to sell stocks in a downturn. And again, you can put that in money market, you can put that in shorter term CDs so that it's accessible and you're not having to sell stocks to cover your portfolio withdrawals. Also, I would avoid large discretionary outlays. If you really hate the ugly tile floor in your kitchen, but like it's not broken and you can still walk on it, maybe put that off. Anything that avoids that will shrink your cash and take away your safety net, we want to avoid. I just like to close with a quote from Warren Buffett. He says, never risk what you have and need for what you don't have and don't need. And my opinion of the current sentiment in the market right now is a lot of people are so excited about the returns that they've seen in their stock portfolio over the last decade or so. They're blindly optimistic to the potential risks, especially if the economy heads for a downturn. I put this out there because, again, it's untethered from to reality. I think a lot of investors right now are truly untethered to reality, and they're not paying attention to the signs that are out there that stock valuations are stretched, the economy is slowing down. And if those two trends continue, then I think it's a potential for very steep losses. Again, I don't know when, but it's becoming increasingly likely that that could happen. All right. Thank you so much for watching. If you have questions, there's my email address and my phone number, and I'll talk to you later.